Imagine reporting over $81 billion in revenue, beating every single Wall Street earnings expectation, and then uh, just sitting back to watch your stock instantly tank 10%.
Yeah, it sounds completely backwards.
Right. But that is exactly what happened to Microsoft in April 2026. Welcome to the deep dive.
Glad to be here.
So for you listening, we are looking at a really massive equity valuation report on Microsoft today. This is a company currently sitting at, well, a staggering $4 trillion valuation.
Which is just a massive number to even wrap your head around.
It really is. And our mission today is to look past the sensational headlines. We need to figure out if this historical spending spree on artificial intelligence is actually building an impenetrable economic moat.
Or, if it's just a bottomless money pit. Because the answer to that question fundamentally alters the risk profile of almost every retirement account out there.
Exactly. I mean, if you hold a standard S&P 500 index fund, you are heavily invested in this transition, whether you consciously chose to be or not.
You're in it. You are definitely in it.
Okay, let's unpack this tension. Microsoft's stock is down nearly 12% year to date. And the entire market is basically holding its breath for the upcoming April 29th Q3 earnings report.
Right. They want proof that this entire AI narrative is financially sustainable.
But if they just beat expectations, why is the market punishing them? I mean, $81 billion in revenue is no joke.
Well, the fear isn't coming from a lack of revenue. If we look at the previous quarter, so Q2 of fiscal year 2026, the operational performance was spectacular.
Yeah.
I mean, they brought in $81.3 billion. That is a 17% increase year over year. The Intelligent Cloud division alone crossed $50 billion in revenue for a single quarter.
Wow.
And earnings per share beat estimates by over 7%.
Hold on, though. For a company that was founded in the 1970s to still be growing top-line revenue at 17%.
Wild.
That basically breaks the law of large numbers. So how on earth does the stock drop after a performance like that?
What's fascinating here is that it's all about the cost required to generate that growth. The market is experiencing what the research calls a decoupling of capital expenditures from revenue growth.
Okay, a decoupling.
Yeah. Yes, the revenue is breaking records, but the underlying infrastructure required to generate that revenue is just bleeding cash. In that same 90-day quarter, Microsoft spent $37.5 billion on capital expenditures.
Wait, $37.5 billion in one quarter.
Just one quarter.
Let me do the math on that really quick. That's just under $416 million a day.
Exactly.
Every single day. I'm trying to wrap my head around that scale. Because this feels like buying a massive, beautiful mansion, but suddenly panicking when the first month's electricity and maintenance bill arrives.
That is a perfect analogy.
You don't spend $400 million a day typing code. What is that money actually buying?
It is buying concrete, steel cooling systems, and highly specialized silicon. Institutional analysts like Keith Weiss at Morgan Stanley, they're pointing out that Microsoft is basically being forced to pay a massive AI tax just to maintain its leadership position.
An AL tax.
Right. Investors are staring at that daily $416 million bill, and they are demanding an ROI timeline. Like, when does that upfront capital expenditure turn into pure profit margins?
Right, because heading into this Q3 report, the consensus estimates demand $81.43 billion in revenue and an EPS of 4.06. And they expect Azure to grow by 37 to 38%.
But hitting targets isn't enough anymore. They need to prove the spending plateau is in sight.
Which shifts our focus from the financial statements to the physical reality of what they're constructing. The research mentions they're operating over 400 data centers across 70 global regions.
It's a truly planet-scale deployment.
Right. Here's where it gets really interesting to me. We're talking about planet scale, but the research mentions the Fairwater data center and these massive power needs. At what point does the physical world, like literal electricity and supply chains, put a hard ceiling on this digital growth?
If we connect this to the bigger picture, the short-term bottleneck isn't just money. I mean, they have the money.
Sure.
The bottleneck is the physical scarcity of the actual hardware required to run these models.
Are we talking about the advanced AI chips, like the GPUs?
Yes. Specifically, the H100 and B200 GPUs from NVIDIA. There simply aren't enough of them in existence to meet the global demand right now.
But why can't they just make more? I mean, if Microsoft is waving a $37 billion checkbook around, shouldn't the supply chain just speed up to take their money?
You would think so, but the semiconductor supply chain doesn't care how big your checkbook is. Building a B200 chip isn't just about printing silicon. It requires incredibly complex advanced packaging techniques.
Ah.
And The foundries that actually assemble these chips, primarily TSMC in Taiwan, they only have so much physical capacity. It takes years and billions of dollars to build a new fabrication plant.
So the supply of these critical chips is capped by the laws of physics and manufacturing timelines.
Exactly, which means Microsoft is caught in a zero-sum game internally. If the supply of chips is capped, they have to ration them.
Wow, so they're fighting themselves.
Yeah, that internal war for resources is causing genuine friction. Management has to play a delicate balancing act every single day. Do they allocate their scarce GPU computing power to their external Azure cloud customers?
Right, these are massive enterprise clients paying top dollar to rent that computing power.
Exactly. Or do they redirect those precious chips internally to power Microsoft's own consumer-facing AI products like Copilot? The research notes that this balancing act actually slightly moderated Azure's headline growth rate recently.
Which obviously contributed to the stock volatility. They almost have to prioritize Copilot, though, right? Because the user adoption numbers in this report are just insane. Over 100 million monthly active users on Copilot.
Oh, it's staggering.
Yeah, and 80% of the Fortune 500 using their Azure AI Foundry platform. Plus, 20 million developers relying on GitHub Copilot as an AI peer programmer. If you have that many people actively using the tool, you can't just let the servers crash because you rented the chips to an outside client.
You really can't. And there's a deeper strategic reason they prioritize those internal users. The research outlines something called the AI feedback loop.
Okay, how does that work?
By being the first to deeply integrate OpenAI's massive models into everyday enterprise software, Microsoft created a data flywheel. So every time those 100 million users ask Copilot to draft an email or summarize a meeting, that data helps refine the model's performance.
Right, and better performance naturally attracts more users.
Exactly, which generates even more behavioral data.
So the flywheel spins faster, creating a wider moat against competitors. But a flywheel of that size requires immense amounts of energy, like we mentioned earlier at that Fairwater data center. At a certain point, don't you run out of literal electricity?
Energy grid limitations are a huge structural long-term risk. You can't just plug a 100-megawatt data center into a suburban power grid.
Yeah, that would blow out the whole neighborhood.
Exactly. They're having to invest directly in energy infrastructure. They're exploring nuclear options, revamping cooling systems, just to keep these intelligence refineries from literally melting down.
Wow.
Add to that the constant regulatory scrutiny. Antitrust regulators in the EU and the US are hovering.
Right. They are analyzing how Microsoft bundles its software and questioning the exclusive ties with OpenAI.
If regulators decide that ecosystem is too dominant and force Microsoft to unbundle its services, that feedback loop could be severely disrupted. So the structural risks are everywhere.
Okay, so building 400 global data centers, fighting over scarce chips, and fending off global regulators is historically expensive. How are they actually paying for it?
That's the billion-dollar question.
Right, because if I look at a telecom company that builds a massive 5G network, they usually drown in debt for a decade. But Microsoft doesn't seem to have that problem.
That is where the operational brilliance of this company really shines. They are funding this historically massive technological transition using the cash flow from a completely different part of the business.
Wait, let me guess. Is it the productivity and business processes segment?
You get it.
So basically, Microsoft 365, LinkedIn, Dynamics, Word, and Excel.
That is the cash engine. That segment alone still pulls in over 27% of their total revenue.
It feels so counterintuitive. We are talking about cutting-edge artificial intelligence, but the whole thing is being financed by the boring legacy software suite. It's like this incredibly wealthy sugar daddy funding all the sexy, expensive AI token factories.
That's a funny way to put it, but yeah. Legacy software has incredibly high margins. You write the code once, and you sell infinite digital copies through a subscription model. It is an asset-light, cash-generating machine.
But wait, isn't the whole point of AI to eventually replace those legacy apps? If they're building AI agents that can do our work for us, aren't they basically funding their own obsolescence?
Well, this is where Satya Nadella's management strategy is so crucial. They are not using AI to replace the legacy apps. They're using it to supercharge them.
Oh, I see.
It's a software as a service, or SaaS, expansion strategy. By bolting an AI assistant like Copilot directly onto existing software like Word or Excel, they aren't cannibalizing their user base. They are simply increasing the average revenue per user, or ARPU.
Okay, so if I'm a business using Microsoft 365, I still need Excel. But now Microsoft comes to me and says, hey, for an extra $30 a month per employee, we will add an AI assistant that builds your spreadsheets for you.
Exactly. The core product remains, but the revenue they extract from you goes way up.
That is a brilliant upsell mechanism.
Yeah. And while that segment provides the steady cash, the intelligent cloud segment is now the biggest driver of revenue overall. It accounts for nearly 35.6% of the total pie. Azure alone crossed $75 billion in annual revenue for fiscal year 2025.
But this transition to cloud and AI fundamentally alters what kind of company Microsoft is, right? A decade ago, they were an asset-light software company. Today, they are a capital-intensive infrastructure behemoth.
Totally different beast now.
Let's look at the actual costs, because they are mind-boggling. The report shows their fixed costs, meaning property and equipment, the concrete and servers, hit $64.6 billion in FY 2025.
Right, and once you pour the concrete and install the servers, that cost is fixed. But the variable costs, the things that fluctuate based on usage, are also skyrocketing. They have massive bills for electricity, cooling water, and human labor.
Labor is a huge one in this report. There's a stat in here that they have 34,000 full-time engineers dedicated entirely to the Secure Future initiative. Why do you need the population of a small city just doing cybersecurity?
Think about what they are hosting. When you are the centralized hub for the world's corporate data, AI models, and intellectual property, a security breach isn't just a PR nightmare.
It's catastrophic.
Exactly. It is a structural threat to the entire business model. If Fortune 500 companies don't trust the Azure cloud, the intelligence refinery shuts down. Those 34,000 engineers are basically the private army guarding the moat.
And they are spending aggressively to make sure everyone knows they own that moat. Advertising spend jumped 23.5% in 2025, hitting $2.1 billion to maintain that AI frontrunner status.
They are operating with the aggression of a hypergrowth startup, but they are doing it at a $4 trillion scale.
And we know the company is an operational juggernaut. They have brilliant management, a massive moat, and an incredible cash engine. But here is the critical pivot for anyone listening today. A great company does not automatically equal a great stock purchase.
No, it certainly does not. The price you pay for the asset determines your return.
Which brings us to the cold, hard valuation math, the deep value investor's dilemma. This is where things get really confusing for a traditional investor. I'm looking at the value metrics in the report right now. Microsoft has a price-to-earnings, or PE ratio, of 26.5.
Right.
And their price-to-book ratio is 8.1. Now, correct me if I'm wrong, but book value is basically what the company would be worth if you sold off all its physical assets, paid off the debts, and liquidated it, right?
Essentially, yes. It is the net asset value on the balance sheet.
Okay, so trading at 8 times its book value means you are paying an 800% premium over the actual tangible assets. By strict traditional value investing standards, this stock looks horribly, dangerously overpriced.
On paper, yeah, it looks terrifying.
And yet the research notes that Michael Burry, the famous value investor from The Big Short, who is notorious for betting against bubbles, he recently bought into Microsoft. What is a deep value guy like Burry, seeing that these traditional metrics are completely missing? Why touch a stock with an 8x book value?
This raises an important question. He is recognizing that traditional metrics like price to book were designed in the 20th century for industrial companies. Railroads, steel mills, car manufacturers.
Physical stuff.
Right. They fall apart when you apply them to a digital behemoth where the most valuable assets are software ecosystems and developer networks, which just don't show up neatly on a balance sheet.
That makes sense.
When investors like Burry look at Microsoft today, they ignore the book value and focus intensely on the quality of the cash flow.
Meaning they want to see how efficiently Microsoft is turning that massive $37.5 billion quarterly CapEx spend into actual profit.
Exactly. The critical metric to watch here is return on invested capital, or ROIC. Despite spending tens of billions of dollars every quarter on new data centers, Microsoft's ROIC has remained remarkably stable at around 21 to 22%.
So for every dollar they pour into this AI transition, they are generating over 20 cents in return. That proves the CapEx isn't just vanishing into a money pit. They are actually finding highly profitable places to deploy that cash.
Furthermore, you have to look at the PEG ratio. That's the price to earnings to growth ratio. This is a metric that factors in the company's expected growth rate. A PEG ratio under 1.0 generally suggests that a stock is undervalued relative to how fast its earnings are growing. Microsoft's PEG ratio currently sits at approximately 0.93.
Wait, so even with a PE ratio of 26.5, the PEG ratio is under 1.
Mathematically validating the growth, yeah.
That implies their earnings are growing so fast in the high teens that it justifies the high multiple.
It does. And the risk of that multiple contracting is buffered by an absolute fortress of a balance sheet. Their debt-to-equity ratio is a microscopic 0.10.
Wow, so almost zero debt.
They use almost no leverage. Their free cash flow margin, the cash left over after all operating expenses and capital expenditures are paid, has remained above 25% for a decade. Over the trailing 12 months, their free cash flow was $75.3 billion.
That is just staggering. And what are they doing with that cash? The report says they've returned over $368 billion to shareholders over the last 10 years. In just the 12 months ending September 2025 alone, they bought back $51.7 billion of their own stock.
Stock buybacks of that magnitude send a very clear signal to the market. Management is looking at their own company, trading near record-high valuations, and concluding that buying back their own shares is still the most accretive place to park $51 billion.
They are definitely putting their money where their mouth is regarding the AI pivot. But let's pause here because there's a reality check in the report that we cannot ignore. The researchers built a discounted cash flow model, or DCF. For a listener who doesn't build financial models all day, let's break this down. Why are we discounting cash? Isn't a dollar just a dollar?
Well, not in finance. A DCF model relies on the concept of the time value of money. Simply put, a dollar Microsoft promises to make 10 years from now is worth less to you today because of inflation. And because you could have invested that dollar somewhere else in the meantime, say, in a treasury bond.
Okay, that makes sense.
So analysts project out all the cash the company will make in the future, and they discount it back to its present-day value to figure out what the stock is actually worth right now. We call that the intrinsic value.
Okay, so the DCF reveals the actual worth of the company based on its future cash generation. The report models a few different scenarios. The first is a zero-growth scenario. Imagine the AI bubble bursts, the $37 billion in CapEx only maintains their current market share, and their cash flow never grows again. What happens to the stock?
In that zero-growth scenario, the intrinsic value of the stock drops to $155.04.
$155. The stock is currently trading around $424. If growth stops, the floor falls out completely.
It is a massive downside risk. But let's look at the nominal case, which is the baseline expectation. If Microsoft continues its historical trend and grows free cash flow at about 15% every year for the next decade, the intrinsic value of the stock calculates out to $399.19.
Hold on. So if they execute perfectly, navigate the physical hardware shortages, fend off global regulators, and maintain a blistering 15% growth rate for an entire decade, the stock is worth roughly $400.
But based on those cash flows, yes.
But it's trading at $424, which means at current prices, there is absolutely zero margin of safety right now. You aren't getting a discount. You are paying a premium price that fundamentally demands perfection. If they stumble, or if that massive AI tax doesn't quickly translate into profit margins, this valuation has a very long way to fall.
That's the reality of it. The current share price fully bakes in a decade of uninterrupted mid-teens growth. It is the ultimate tension for an investor.
So, to synthesize this entire deep dive for you, Microsoft has essentially defied the economic law of large numbers. They are managing the most capital-intensive technological transition in human history, building these planet-scale intelligence refineries, and they are funding the whole thing with an absolute fortress of a legacy software business.
Yeah, from a deep value perspective, the stock does not offer a traditional margin of safety. However, it represents what many consider the ultimate Buffett-style compounder.
A great business at a fair price.
Exactly, rather than a mediocre business trading at a great price.
Now, before we wrap up today, I need to read a mandatory disclaimer sourced directly from the research text. Disclaimer. All financial data and analysis discussed today is based on publicly available sources and may be subject to revisions or differing interpretations. This deep dive is for informational purposes only and does not constitute investment advice. Please conduct your own due diligence with a licensed financial advisor before making any investment decisions.
Always vital to do your own homework, particularly when assessing valuations in uncharted technological waters like this.
Absolutely. And speaking of uncharted waters, we want to leave you with a final provocative thought to mull over.
Yeah, we've spent this entire discussion focusing on the billions of dollars Microsoft is deploying to build these massive AI infrastructure moats. But consider this alternative future. What happens if AI agents become entirely commoditized over the next 5 years?
Commoditized, like cheap and everywhere.
Right. If open source models improve to the point where every tech company on Earth can produce cheap, highly effective AI, does Microsoft's multi-billion-dollar infrastructure moat suddenly transform into a permanent margin-crushing tax?
Wow, because if intelligence becomes as cheap and abundant as tap water, being the world's most expensive water utility is suddenly a terrible business model.
Exactly. It is the ultimate tension between massive innovation and rapid commoditization.
Definitely something to think about the next time you use an AI assistant to draft an email. Thanks for
Yeah.
taking the deep dive with us.